Hello, welcome to Any Answers Answered for February 2024. Hopefully tax returns are a dim and distant memory at this point, and we can start to look forwards to whatever 2024 has to offer. As ever, Tim and I are here to have a look at two questions from the pages of Any Answers. And Tim, our first question this month comes from the rather brilliantly named GSWB 1954. It's an interesting question. It took me quite a while to work out what they were really asking, and it's not what I think they are asking, if that makes sense. Let me explain. It's headed up as incorrect claim for business asset disposal relief. And the advisor here has prepared a tax return for this particular client for 2023, including a CGT computation claiming business asset disposal relief, and therefore 10% tax. Since filing the return, it has come to my attention that the client is continuing to work in the same industry as a director in a husband-wife limited company, and this person has suggested that he reconsiders the claim and files an amended tax return. But he's reluctant to do any of these things. Should I therefore cease to act as his advisor? So this sort of becomes a money laundering question. David Winch actually has given a very full and very sensible answer here. But what I would say is this is nothing to do with business asset disposal relief at all.
No, the fundamental point is whether the targeted anti-avoidance rule that applies where a company like this is wound up and the reserves are distributed to the shareholders, whether that targeted anti-avoidance rule will result in the distribution to shareholders being treated as an income distribution rather than a capital gain. Now, many viewers will remember the old extra statutory concession C16, under which, providing conditions were met, on the winding up of a limited company, the receipt by the shareholders of the distributable assets would be treated as capital rather than, as the legislation provides, a distribution. But C16 was replaced by specific legislation many years ago, and we now have to consider whether the distribution falls within the amended legislation, allowing it to be a capital gain, or whether it's a distribution. And essentially, if the distributable assets on the winding up do not exceed £25,000, then the distribution is treated as capital, which of course would then enable business asset disposal relief to be applied if the relevant conditions were also met for business asset disposal relief. So that's if it's less than 25,000. Alternatively, if the distributable assets are more than 25,000, you would need to appoint a liquidator and have the company formally liquidated, incurring the cost of that, for the distributions to be treated as capital. However, that capital treatment is subject to a targeted anti-avoidance rule. And one of the conditions or circumstances, I should say, in which the capital treatment will not be available, despite there being a liquidator or the assets being less than 25,000, would be if the taxpayer continues to be or becomes involved in the same or similar business within 2 years after the distribution. And that gets me back to GSWB 1954's, I wonder if you're of the same age as me, GSWB. That's my year of birth, 1954. If so, congratulations for your forthcoming 70th. But anyway, gets us back to his or her or their question, because presumably what's happened here is that at the time of the original disposal in 22-23, the treatment was capital, thus enabling a valid claim for business asset disposal relief, but subsequently the targeted anti-avoidance rule has cut in because of the client continuing to work in the same industry within 2 years, and that means that it shouldn't have been treated as capital, it should be treated as income. And that's what the accountant would have suggested to the client, and I suspect that the accountant is right on that, although it did need that further analysis as to what we're talking about here. And as Giles has already mentioned, have a look at the postings in response to this Any Answers question, and in particular, David Winch's posting, which gives a detailed analysis of the circumstances in which a suspicious activity report should be filed and in which the accountant should cease to act and notify HMRC.
Whenever we look at this area, one of the key requirements of the target anti-avoidance rule is whether or not one of the main or sole or main aims of the particular route taken was to avoid taxation. And of course, if you can demonstrate, if you have paperwork that shows that this was nothing to do with taxation and actually there were perfectly legitimate reasons for the liquidation of the company, then you shouldn't have a problem. So as ever with our questions, the honest answer is we probably need more information to fully answer this question properly. Our second question this month comes from, the person's name is SA 2016. I don't know if they were particularly good at self-assessment that year, but SA 2016 has raised the question, and it is cycle to work yet again. I understand, says SA 2016, the company director or shareholder can purchase a bike in his company and reclaim corporation tax, VAT, with no benefit in kind. But are there upper limits on the cost? For example, some people might buy a £500 bike, some people might spend £10,000. Is there an issue with this? I would say the answer quite simply is yes, there is.
Yes, and urban myths abound here. First, the idea that whenever an employer provides a bicycle to an employee, it can be tax-free under the Cycle to Work scheme. But of course, as you and I and lots of others will appreciate, it does what it says on the tin. It's an exempt benefit for the provision of bicycling equipment used to cycle to work. And the rule of thumb here is that at least 50% of the time, preferably more than that, the bicycle should be being used to cycle to or from the employee's place of work. And that is something that is very often, too often forgotten. And so you get companies providing, typically directors, with bikes costing £5,000 or even more. And those bikes are simply used recreationally at weekends and never used to cycle to or from work. Well, in that case, the provision of the bicycle will be subject to the normal benefit in kind rule. 20% of the cost of the bike will be assessable and should be reported on the P11D. There is a further urban myth about the limit on the cost where the cycle to work rules are otherwise followed. And the urban myth is that there's a maximum £1,000. But that £1,000 limit is not engrossed in the tax legislation. It's simply a reflection of consumer credit rules and would only be relevant where the employer is providing a cycle to work scheme under which there's some sort of salary sacrifice so that the employee is effectively hiring the equipment from the employer. And because of consumer credit rules, unless the employer is licensed for consumer credit legislation, there is that limit of £1,000. But in the case that we're looking at here, presumably it's a director shareholder of their own company, and they simply want, as you would, to take advantage of any tax-free benefits, get the company to buy a bike. It could cost £10,000. And yes, that will be a tax-free benefit, but provided its predominant usage is commuting to work. And it's unlikely that that is the predominant usage, in which case we should take the 20% annual value.
I was actually speaking to somebody from the revenue about this once, and the way he explained it was beautiful. One of the first things they will check is where you live and where you work. That is one of the biggest clues in whether you are cycling to work. If you live in Milton Keynes and your job is in Cambridge, it's unlikely you cycle to work. The other thing, though, where people think this limit on the cost comes in, is that if you were going to cycle into work in London, you would probably buy a bike for 500 quid. You would not take a £10,000 bike into London and leave it chained up somewhere. And as a result, if you saw as the revenue that money was being spent in that way, it's questionable as whether that's actually the bike they're going to use. Anyway, be aware of the issues, hopefully useful to those people who ask questions and everybody else as well. Do keep posting on the pages of Any Answers, and perhaps next time it'll be your question we have a look at. For today, bye-bye.